The capital asset pricing model is a simple model used to determine the expected return of a stock based on its market risk. Now, the formula for it is very simple, and in this video we're going to break down each of its components and apply it to some examples. Now, using those examples, we are then going to visualize it through the security market line. On top of that, we are going to look at its origins and who its founding fathers are, as well as distinguishing the different types of risks there are, and last but not least, having a look at how to apply CAPM to DCF analysis and also its importance in doing so. Let's get right into it.
The capital asset pricing model has three components: the risk-free rate, the beta of the stock, and the market risk premium, which is captured within the brackets. And so the expected return is equal to the risk-free rate plus systematic risk, which is represented by beta, relative to the market risk premium. The market risk premium, which is represented by the expected return of the market minus the risk-free rate, is the additional return an investor will receive from holding a risky market portfolio instead of risk-free assets. Beta measures the sensitivity of the returns of a stock to the market's returns. From the formula, we can establish that the model shows a linear relationship between the required rate on an investment and risk. Now that we have looked at the formula, we can apply it to some examples. Now let's have a look at the examples. Starting off, we have the risk-free rate of 5% and the market return of 12%. We're going to apply that to three hypothetical stocks. So starting with stock A, we have an expected return of 15% and a beta of 0.5. Let's have a look as to why it's considered undervalued, and we will use the CAPM formula we previously looked at. However, it's important to mention at this stage that as we are given the expected return of the stocks, we do not plug it into the equation, as the return we get from the equation in this case is considered the required rate of return. When expected return is greater than CAPM, which is the required rate of return in this case, the stock pays more than the risk requires, hence why it's undervalued. When the expected return is less than the required rate of return, the stock pays less than the risk requires, hence why it's overvalued. And lastly, when the expected return equals the required rate of return, the stock pays exactly what the risk requires, hence why it's fairly valued. So going back to our example with stock A, if you plug in the risk-free rate, beta of stock A, and market return, you'll get 8.5% required rate of return. We then compare that to the expected return of stock A, and because the 8.5% is smaller than the expected return of 15%, we come to the conclusion that stock A is undervalued. Looking at the security market line visualization in the next part will make this so much easier to understand once we visualize it. Then moving on to stock B, we have an expected return of 15.5% and a beta of 1.5. So we simply go through the same process as for stock A. This time the required rate of return and the expected return of stock B are identical, which tells us that stock B is fairly valued. And then moving on to the last one, stock C, we have an expected return of 8% and a beta of 1.2. And once again, for stock C, we go through the same process by plugging the values we have into the CAPM equation. If you look at the three equations, you can see that it is only the beta of each stock that is different in the formulas we have on the right side of the screen. The risk-free rate and market return stay the same, and hence does the market premium. In this case, we can see that the expected return of stock C, which is 8%, is less than the required rate of return of 13.4%, which goes to show that stock C is overvalued. Now, I understand that this may seem overwhelming and also confusing as to how we have both the expected return and required rate of return for the stocks, but let's visualize the capital asset pricing model using the security market line, and hopefully that should give you a better understanding. Let's now look at the security market line, which is a graphical representation of the CAPM. This plots an asset's expected return on the vertical axis against its systematic risk on the horizontal axis. As this is a linear graph, we can see that a higher beta corresponds to higher expected returns. Before we interpret the graph, it is worth noting that the risk-free rate is the vertical intercept of the line. This is because it represents the required return for an asset with zero systematic risk. And also, the red dot in the center, which is labeled with a capital M, is the market portfolio as it lies on beta 1, which is always the market beta. Let's now translate the stocks we calculated previously into the security market line. Any stock that lies above the security market line, in this case stock A, is considered to be undervalued. This is because it provides a higher return for the required risk. A stock that lies exactly on the security market line is considered to be fairly valued. In this case, we can see that stock B lies exactly on the line, and so it's correctly priced. A stock that lies below the security market line is overvalued as it provides a lower return for the required risk. In this case, we can see that stock C lies below the security market line, and so it's overpriced. Let's now have a look at the origins and evolution of the CAPM. As with any model, the CAPM comes with its flaws. However, multi-factor models such as the Fama-French 3-factor model and the 5-factor model attempt to address the CAPM's limitations, but we will not delve into too much detail in this video. But let's have a look at the model's origin and how it came about. The CAPM was introduced by William Sharpe and John Lintner, which builds on the model of portfolio choice work developed by Harry Markowitz in the late 1950s. Markowitz's model suggests that investors choose a portfolio that will minimize the variance of a portfolio return given a specific level of expected return. Thus, it is also called the mean variance model, acting as the foundational work for the capital asset pricing model, by introducing the idea that diversification could reduce risk without sacrificing return. William Sharpe and John Lintner developed Markowitz's model of calculating thousands of complex correlations by introducing beta as the measure of a stock's sensitivity to the market and introducing the foundational idea that investors should only be compensated for the systematic risk that cannot be diversified away. Therefore, the beta tells us exactly how much extra return we should demand for a stock's exposure to the market, and it tells us the relative sensitivity to the market. It is also worth noting that the market beta is always 1. With that, the capital asset pricing model formula was born, providing a linear relationship between risk and expected return, which we saw visualized previously by the security market line. The same William Sharpe created the Sharpe ratio, which we will also cover in future videos. As with any model, the CAPM came with its flaws, and by 1980s, researchers began to add on assumptions like those of Eugene Fama and Kenneth French, who argued that beta alone wasn't enough to capture all systematic risk. And with that, in 1992, they introduced the Fama-French 3-factor model that added 2 more factors, those being size and value. And most recently, in 2015, they expanded the formula once again after realizing that as markets became more complex, the 3-factor model left some returns simply unexplained and that it wasn't enough. With that, the Fama-French 5-factor model was introduced, adding the additional 2 factors of profitability and investment. The 5-factor model is the most accurate and most commonly used for academic finance and research, but the CAPM is still largely used by a great number of industry professionals, such as investment bankers, simply due to its simplicity. We will shortly see how CAPM is used in DCF analysis. So before we have a look at how to apply CAPM to DCF analysis, let's have a look at the different types of risk. So far, we have briefly covered the idea of risk and how it affects the model. Now, risk can be split into 2 types, systematic and unsystematic risk. A graph has been included to help you visualize the two types of risk. On the y-axis lies the total risk, measured as the standard deviation of the portfolio. On the x-axis lies the number of stocks, and the shaded red area indicates the systematic risk, which no matter how many stocks you add, you cannot eliminate, and you can't go below the baseline. Systematic risk is the market risk which is not diversifiable. This can be macro events such as interest rate fluctuations and recessions. These affect everyone in the market and cannot be avoided, and so you get a premium for incurring that kind of risk. This is represented by the red area in the graph on the right. You can see that even as the number of stocks in the portfolio rises, the systematic risk remains unchanged. On the other hand, we can see the blue curve, which diminishes as the number of stocks in the portfolio increase. This represents the unsystematic risk, which is also called firm-specific risk, which is diversifiable, and we see that as the number of stocks in the portfolios increase, the unsystematic risk diminishes. Idiosyncratic risk can be micro events like bad management or other firm-specific shocks. Earlier, we had a look at beta and how it shows the relative sensitivity of a stock to the market. If a stock has a beta of 1, it has the exact same amount of systematic risk as the average of the whole market. If the beta of a stock is 2, then it is very sensitive to the market shocks. And if a stock has a beta of 0, then it suggests that the stock's returns are completely uncorrelated with the movements of the market. Now, let's have a look as to how we apply CAPM to DCF analysis. The result we get from the CAPM formula is the cost of equity, which is represented by RE within the weighted average cost of capital formula, which we also covered in our previous video on DCF analysis. The cost of equity lies within the first bracket of the WACC, and we can see that if CAPM gives you a high cost of equity, the WACC in turn will go up. The WACC is then implemented into the present value of terminal value formula within the denominator and acts as the discount factor. So if you look at the logic and go step by step, if you have a high risk, that will mean you have a high beta, which will lead to a high CAPM or cost of equity, leading to a high WACC, and the ultimate result of that, as seen when applied to the present value of terminal value, is a lower present value because the future cash flow is penalized for being more risky, and vice versa. A lower CAPM return, because of the low risk, will lead to a lower WACC, which will give you a higher valuation, as the cash flows are seen as much safer due to the lower risk. With all of that, I hope I have given you a good introduction and understanding of the CAPM, the formula used and how to interpret it, as well as the origins of it and how it can be applied to DCF analysis. Thank you very much for watching.